Big day for the Fed here in the U.S. today. No decision expected on rates, but a lot of focus on the J-Powell news conference, of course, and also the FOMC rate expectations. What are your expectations when it comes to the tone and also how the FOMC members, how they see rate cuts going forward?
Sure. This is, as you said, it's quite a pivotal meeting. Now, what we're anticipating is that the dot plot, the Fed dot plot, still holds 3 cuts for this year. But it's really important to say that this is a very, very fine balance here. You just need 2 more members to raise their forecast, and you're going to have just 2 cuts for this year. So I think there's a fairly easy way of seeing that actually you're going to see a slightly more hawkish Fed coming out today. And that's why it's so pivotal. I think for the FOMC members, they have got their concerns. You know, the 2 very hot inflation reports that we've just had over the last 2 months are raising some doubts about how quickly they can get inflation back to target. So that's going to be the key that we're watching out for from Powell, from the press conference. It's going to be, as I said, very important for markets today and what comes out from this meeting.
You know, Seema, I know you're very focused on that hotter than expected CPI that we got, a headline of 3.2%. But I do want to ask you, how big of a factor is that? Jay Powell made it very clear when he was on Capitol Hill, at least, that they're going to continue to look at these inflation reports. And of course, coming up in just about a week and a half, we have PCE, which we often call their preferred gauge.
Right. And the inflation reports that we've had over the last week or so from the CPI and the PPI print gives a fairly good indication of what to expect for the PCE number. And that is also going to be a little bit hotter than what was initially expected. So these are important prints, but you're right to say that, look, we have been expecting this, well, we haven't been expecting this to be a straight downward line back to the 2% level. It was always going to be quite bumpy and quite a volatile move. But the problem is that once you've got 2 reports like that, there does introduce some hesitation, some doubts about how easily the Fed is going to get back to that 2% level. I would say that the next print in March and, of course, April, those are going to be very, very important prints. If they come out stronger than expected, then I think that the market will have quite a significant setback because there will be growing concerns that you're looking at a resurging inflation trend.
All right. So I think here's the real question, especially for investors. I know that you're bullish when it comes to equities here in the U.S., but how much of your thesis is it depending on 3 rate cuts, the possibility of 2 rate cuts? Does that change your outlook, at least when it comes to U.S. equities?
It's a great question. So look, for equities, if they were to come out and say just 2 cuts in the dot plot this year, then maybe that's a bit of a setback for the equity market, but fairly short-lived from a broad perspective, because actually the earnings trajectory is still very strong. And that is really the key company fundamentals which will be driving the equity market. However, when you start to look at pockets like the small cap area, they are fairly dependent on the idea that there will be rate cuts coming through this year. So it just depends on which parts of the market you're looking at. The broad market we think will do well either way this year. It's just the pockets which have been somewhat underappreciated that we have been hoping will have a stronger second half of the year. That is dependent on the rate cut expectation.